In this video, we're going to look at how to determine our cost of goods sold under both absorption and variable costing, and how to put together the income statements under absorption and variable costing. So it tells us in the information provided that in the most recent year, Osterman Company had the following data. So they had no units in beginning inventory. They produced 10,000 units. They sold 9,300 units for $47 per unit. Their variable costs included direct materials, direct labor, and variable overhead. And their fixed costs included our fixed overhead per unit and our fixed selling and administrative expenses. So they ask us to, again, calculate the cost of goods sold under absorption costing and prepare an income statement under absorption costing. So before we can calculate our cost of goods sold, we have to first calculate our per unit product cost under absorption costing. So under absorption costing, it includes our direct materials, our direct labor, our variable overhead, and any fixed overhead that we have. Again, when you're thinking about absorption costing, think of it like a sponge. It's sucking in or absorbing all components of product cost. It isn't leaving anything out. So we had $9 in direct materials, we had $6 in direct labor, $4 in variable overhead, and $5 in fixed overhead. So in total, our per unit product cost under absorption costing is $24. So now we can figure out our cost of goods sold. They told us that we sold 9,300 units, and we know that each one of those units cost us $24 to produce. So our cost of goods sold is $223,200. We can now put together an income statement. When we're doing absorption costing, we do a traditional income statement, breaking apart our costs between product cost and period cost. So we start with our sales. Again, we sold 9,300 units, and they told us that we sold them for $47 a piece. So we have our 9,300 times our $47. So we had revenue of $437,100. We also have cost of goods sold. We just calculated that number right here. So we subtract the two to get our gross profit or gross margin. And it gets us a gross profit or gross margin of $213,900. We then need to still subtract away our selling and administrative expenses. And they told us in total our selling and administrative expenses were $138,000. So we subtract those away to get to our operating income for the period of $75,900. Again, with absorption costing, we're breaking apart our costs between product versus period cost. So our product cost includes all components of product cost, our materials, our labor, and all overhead, both variable and fixed. And our period costs include everything that happens after we produce our product, such as selling and administrative expenses. They want us to use the same information and do it now using variable costing. So again, the first thing that we have to do is figure out our per unit product cost under variable costing. And under variable costing, we only look at the variable components of our product cost. That's direct materials, direct labor, and our variable overhead. So again, materials were 9, labor was 6, and variable overhead was 4. So that gets us $19 per unit for our product cost, because again, with variable costing, they assume that those fixed costs are really more part of staying in business. So they're categorizing their costs, breaking them out by how they behave, being the difference between variable and fixed. So our cost of goods sold then is going to be the 9,300 units that we sold times our per unit product cost. So our variable cost of goods sold is going to be $176,700. We can now do an income statement. When you're using variable costing, we do a contribution margin income statement because we're segregating out our costs between how they behave, meaning is it variable or is it fixed? So we have our sales of the 9,300 units at a rate of $47 per unit. Sales amount is still the same. We're going to subtract away our variable cost of goods sold that we just calculated above in order to get our contribution margin. So our contribution margin here is $260,400. If we happened to have a variable selling or an administrative expense, we would include that right below variable cost of goods sold before getting to our contribution margin. Because remember, to calculate contribution margin, it's sales minus all variable expenses, not just our variable product cost expenses. Now we have to subtract away all of our fixed expenses. So we had fixed overhead. Our fixed overhead rate was $5 per unit that was, and this is very important, produced, not based on how many that were sold. So we produced 10,000 products or units during this period, so we have to multiply it by the 10,000. Again, the why that we're doing this is that this is seen as a cost just to stay in business. Remember, fixed costs are costs that do not change with the level of output. So we're going to have to pay that amount regardless of how many units were produced or how many units were sold. So it's based on how many units were produced. We also had our fixed selling and administrative expenses of $138,000. So we're going to take our contribution margin, subtract away our two fixed expenses, and we are at $72,400. Notice that our operating incomes do not match, and they should not match. When you are doing variable costing and absorption costing, your operating income should never come out exactly the same because we're treating our fixed overhead differently under each scenario.